afternoon, everybody, and or good morning, wherever you are. I'm Lucrezia Reichlin, and it's a pleasure to introduce the workshop today. It's a workshop that is co-organized with the European Corporate Governance Institute and with the Impact Economy Foundation. I'm here with two hats. The first is chair of the ECGI. And the ECGI is a European Corporate Governance Institute, as I said. Our activities, we are keen to promote a discussion, a wide discussion on sustainability on all its aspects. And so this workshop has to be understood in the framework of these activities we are promoting. And as usual, our goal is to put together good academic research with policy relevant topics. The other hat is that I have, and which is relevant for today's discussion, is that I'm an IFRS trustee and I've chaired the task force on sustainability reporting. And and this is actually what we are discussing today. This is a workshop which is part of the trustees' outreach in the context of a public consultation that we have launched on the desirability of global mandatory sustainability reporting and on the potential role that the IFRS Foundation can have in that context. So all participants had, the link with our document, and everybody is encouraged to respond to our consultation. This is very important for the legitimacy of this exercise. And this is important for us to engage with all stakeholders, the academic community, investors, and public policy regulators, etc. So our chair, Erli Liikanen, will talk more about our document, our consultation document, but I would just welcome everybody and pass the word to Dirk Schoenmaker, who has been my co-organizer in this event, for this event. Dirk.
Thank you, Lucrezia. So my name is Dirk Schoenmaker. Like Lucrezia, I'm also here with two hats, but different hats. First of all, I'm a professor of finance at Erasmus University. I'm teaching there now a lot on sustainable finance. I've written a textbook, Principles of Sustainable Finance, and which is quite uncommon in finance. We have a full chapter on reporting in that book, because without the information, you cannot take decisions. So I think sustainability reporting is key to the practice of sustainable finance. And therefore, I'm really glad that the IFRS is taking this issue up. And we have so many participants. I'm now counting 165 for an afternoon on this topic. My second hat is I'm board member of the Impact Economy Foundation. That is a new institute. We have been established this year. And what we want to do is to help setting practices for impact reporting and also to upscale it and only to help out, because the end game is quite clear. Everybody should do it under the guidance of IFRS, but we have to set the practices and to help out. And that's really interesting to see how things are going. And my colleague Adrian will be later on the panel and show that it is possible in practice, because many people think it's extremely difficult, but in the end, it is doable, and that's quite nice. I would like to start with a really big compliment to the IFRS, not only because they come with a topic, but I think they are the first one who dare to call this topic not non-financial, which is a negative definition, but sustainability reporting, and that's what it is. So I really think it is great that we have now moved beyond this modest non-financial thinking, that we really give it its own name, sustainability reporting. And that is really extremely helpful, because then we can have a proper discussion which items, like climate, which do we first, which do we later, how to stage it, but at least it is clear where we are talking about. So I think that's a good way forward, that we talk today about sustainability reporting and no longer about non-financial reporting, because that is really a strange name. The program is quite full, but not too full, because I've been doing it together with Marco Brecht from European Corporate Governance Institute. And we early on agreed on one item, and that's not to have too many speakers in a panel, because that is extremely painful for the speakers, because then they have to fight for time. But it is also not nice for the participants, because then there's no time left for Q&A. So what we aim to do is that we really allow in each session 15 minutes for Q&A. And please come in with your questions in chat. And then I will, as moderator for a few sessions, and Marco for a few sessions, we will include the chat also in the Q&A. And then we can make it more interactive, and then we have a higher probability that you stay till 7 o'clock on Friday afternoon, if we make it more interactive. Let me just say a little bit about the program. As Lucrezia already said, Erkki, we are very happy to receive him as chair of the IFRS Foundation. He will set out what the aim is of the IFRS and the consultation. And we all hope that you will really engage with the consultation. And of course, accountants, companies, practitioners are already talking a lot about it, but I think the real innovation of this afternoon is that the academics, beyond the usual suspect, like Bob and so on, who are already doing this for the lifetime, but that at a broader scale, finance and accounting and legal academics get introduced to this topic, because it is extremely important to get this right. I've been working for 10 years at the Ministry of Finance, been negotiating directives in Brussels, and there is content and there is form. And this consultation document really combines the two issues. So, and that's why we also need the academics to help out thinking on the content. And we need the policymakers. We really need to combine efforts to make it happen. So that's why the keynote will be academic, because that's what the European Corporate Governance Institute is about. We are really proud that one of our members, Christian Leuz, will be doing the keynote, and my colleague from the Impact Economy Foundation, Adrian, the Groot Ruiz, will do the discussion there. Then we move to the panels. We have 3 panels, and we have a few breaks in between to get some fresh air and to get something to drink. And the first panel is on the global issue, because we all know the IFRS is global, both from the investment industry, and I think it's fair to say that Bob is really the initiator of all these initiatives on sustainability reporting. So we are really glad to have him, and also to have Sandy Bosch from BlackRock. Then we move to the EU perspective, the European Union. We are very happy with Anna Dekkers from the Commission, Rins Abma, my old colleague from the Ministry of Finance in the Netherlands, now at Eumedion. And Eumedion has been really a front runner together with PRI on engagement and combining efforts from the investor perspective towards the industry. And then finally, also from one of the leading countries in Europe, from the Treasury. Then the second panel, or the third panel, will be, we can talk all day about standards, but as all of you know, standards are nice, but if they are not monitored and are not enforced, not much will happen. So the real yeah, the real issue is the bite in the end. Will the dog not only bark, but also bite if things are not done? So we are really very glad that both ESMA and IOSCO are joining us to give their view. So that's the setting for today. I really invite you all to participate and to put things in the Q&A. We cannot promise that we deal with all of them, but you can read them also so that you can also see what's happening. And we will make space in the sessions for the Q&A. So that's the opening. I think we are still slightly ahead of time, but that's very good for today, because Erkki Liikanen was also the first one in the prep call this afternoon. And I now hand over to Lucrezia for moderating the first session.
Thank you, Dirk. Thank you very much for the introduction. So I will just give the floor to Erkki Liikanen, the chair of the IFRS Foundation Trustees, and he will, Erkki, the floor is yours, and we're looking forward for a description of our consultation process. Hopefully this will steer a lovely debate. Thank you.
Thank you very much, Lucrezia. Perhaps when I'm a policymaker, I can make two references to history of these issues. First, in 1970s and 80s, you remember that later Nobel laureate Wilhelm Nordhaus wrote in 1970s already a paper where he said that the greenhouse gas emissions from human activities constitute a negative externality and should be included in the price of taxation. In a Nordic country, Finland, young Minister of Finance was inspired by that, and he proposed a CO2 tax, as today called carbon tax, in 1988, and it was adopted in so that it entered into force 1990. I happened to be that young minister, and it was an interesting experience, but still you learned that national solutions are positive, but when the problem is global, they are neither sufficient nor optimal, and we are still with this discussion. Second phase, which often comes to my mind now when we talk about Paris Agreement, is Kyoto Protocol 97. When Kyoto Protocol was signed in 1997, USA was among the signatories. Then President George W. Bush pulled out of this protocol in March 2001, and USA never ratified it. It was a major disappointment. Little before those events, IFRS Foundation was established, and ISB became the name of the board. In summer 2000, European Commission published a communication on financial reporting strategy. It led to a major reform. By 2005, all publicly traded companies in Europe had to prepare their consolidated financial statements in accordance with international accounting standards. I was in that commission, but these two processes, Kyoto process and reforms of financial reporting, never crossed. They were totally separate. Today, we talk about those issues at the same time. But anyhow, sustainability became a mainstream political issue. The EU decided at the time to prepare a sustainability assessment on all proposals for legislation. Economic, social, and environmental impacts were analyzed. The major reform of chemicals was the first case in point. Also, corporate social responsibility became an important topic. The communication was published in 2001 at the same time. Multi-stakeholder forum was created, but it took a long time before something real happened. Some literature tells that 2013 directive on non-financial reporting was one follow-up. So just about the history, because many of these issues are on the agenda in that discussion still today. But now I move on to our report and to today's situation. There has been a growing number of calls for standardization and comparability of sustainability reporting. And there have been people who have argued that IFRS Foundation should play a role in this area. At the IFRS Foundation, the trustees review the strategy every 5 years, and we are now preparing for it. And we have decided to take sustainability as a separate topic. Consultation paper was prepared by the task force chaired by Lucrezia and Reichlin, and it was published in September, as you know. And now it's open for consultation. To make the logic clear, we start with two fundamental questions. The first is there demand for sustainability standards at a global level? And if the replies lead to a positive consensus, the second question follows, should the IFRS Foundation play a role in this area? If the foundation is asked to play a role, then the consultation paper sets out possible ways forward. And one option is to establish a new separate sustainability board. Board would sit alongside with International Accounting Standards Board within the IFRS Foundation. We think that this approach has merits for both boards. Given the increasing impact of sustainability and climate-related matters in companies' financial statements today already. Many jurisdictions are beginning to require that companies provide climate-related disclosures in addition to the disclosures required by IFRS standards. But for this option of Sustainability Standards Board to be successful, several conditions should be met. First, support is needed from public authorities, global regulators, and market stakeholders. This is very important. Second, new board should work together with regional and other authorities to achieve global consistency and reduce complexity in reporting. The process should build gradually. The consultation paper proposes to start with focus on climate-related reporting standards. It's evident why climate is first. It's most urgent, and more than 100 regulators and government entities support TCFD, Task Force on Climate-Related Financial Disclosures, and TFCD has also created an initial framework. IFRS financial standards have been applied partly or fully in 144 countries. To avoid global fragmentation, a recognized body should develop sustainability standards on the framework. When the climate is a global preoccupation, the solution should have a global dimension, working together with regional or regional plus initiatives. These efforts could and should be complementary. According to our consultation paper, the Sustainability Standards Board would initially focus its efforts on the information which is most relevant to investors. For the new Standards Board to start with a double materiality approach would substantially increase the complexity of the task. It could potentially delay the adoption of the standards. This is one reason why a gradualist approach is recommended. If established, the new board would concentrate on the information which is more closely connected with the current focus of ISB. Later we will see whether this scope should be broadened. Here the cooperation with other initiatives is also very important. The work should take into consideration existing developments and experience in the field. I want to reiterate that this is a demand-driven process. If demand exists, then we will look to examine how to move forward. If you have views on the topic, whatever they are, please let us know. If there's no demand, then there's nothing more for us to do. I want to pay tribute to many organizations in the field, such as SASP, IRRC, GRI, CDP, and CDSP, the 5 standard setters. I also highly appreciate the work of the European Commission and EFRAG in the context of the Green Deal. The role of Europe is crucial in achieving the global solution. This was, by the way, also emphasized by 5 standard setters, which I just mentioned. To make the work of a new sustainability standards board successful, also other conditions need to be fulfilled. There must be adequate, proper governance structure, an appropriate level of resources, including separate funding and technical expertise is needed. But finally, if the conditions will be met, Sustainability Standards Board could be a global building block in standard setting in this area. Thank you very much, Lucrezia.
Thank you, Erkki. Thank you very much. I think the program now, I mean, we'll go straight to the academic keynote, and so the debate will be later, right, Dirk? So it's no discussion after Erkki. You're on mute. Yeah.
Yeah, there is time for a few questions now.
Okay, so because it wasn't stated in the program, great then. Okay, so we take 5 minutes of Q questions on the paper.
Yeah.
Okay, so I should see the little hand, but I don't see any. Marco, do you see hands here in the chat? I don't see any.
There are some questions in the Q&A box, and there's one that has 3 volts by Sarah Jane Dominic in the Q&A box.
Okay.
You want me to read it?
Yeah, why don't you? Can you read it, please?
Yeah. Yes. Is it really sustainability reporting? Sustainability reporting at its core is addressing the need of multiple stakeholders reporting information on how these stakeholders are impacted. The current suggestion is that only the impacts of sustainability factor on the enterprise are to be addressed with the financial impact. What about the impact on the environment and society? Surely that is what we ought to be accelerating the urgency of. The environment is clearly deteriorating before our eyes as increasing inequality. Are these only of interest, or do they have financial implications? I think it is inappropriate to call this sustainability reporting. So that's a long question, but it got 4 votes. So please try to keep your questions short and only write 1 question. Thank you.
Thank you very much. It's a very good question. I mean, of course, environment has many impacts on the society, you know, on people, on social welfare, on equality, and many other issues. But what we propose is that IFRS would start from the investor perspective, and other initiatives in the field could be complementary. So they are not, if we take the investor focus, financial materiality, it is one side, but then the many other initiatives can complement this picture. So I mean, I just agree with you, but you can't do it at the same time. If you want to move globally relatively fast, it's better to have limited focus.
I have here another question who got 2 votes from Eric Brin. What are, in your opinion, the likely potentially path towards global harmonization?
If you look at these areas of sustainability, in the climate, there is more convergence than the others. And of course, the recent political events in the United States that US coming back to support Paris agreements is very important. So in that area, I think it would be important to find now the agenda which could be global, which could unite us all, because the character of the climate problem is global. It doesn't mean that different regions can go even beyond, but in that area, for instance, the work would just be done by GFSD is one good starting point. It is well known and it's a lot of support.
I would get another question on double materiality, since there seemed to be some interest here in double materiality. What is the main complexity of using the dual materiality approach from the onset? From Frédéric Barge.
It's a well, I mean, Lucrezia has worked with that in the task force a long time, but if you want to do something global, which unites the countries in favor of some major solutions, it must be relatively clear-cut. And I think the single materiality gives a good starting point. When you go to double areas, it becomes more complex, it will take more time. And there are also perhaps the objectives in some areas are more controversial than in the climate area.
Yes, if I can add something on that, I mean, I think the double materiality is extremely important, and probably it will be very difficult even in practice to distinguish between single and double materiality. And we are all aware of that. The problem is that if you aim at going for global standards, you also have to bear in mind that legal frameworks and public policy are very different across the world. And so from a pragmatic point of view, to start from the narrow concept of single materiality, but remaining open to, in a dynamic way, to enlarge to double materiality is probably the most efficient solution. So more actually, realistic solution. And we have this idea of double materiality, of dynamic materiality, which is also an idea that we share with a group of 5, and we are developing a way together. Okay, so how we can move in a dynamic way towards a more comprehensive idea of materiality. And this is something that I'm now relating to another question, which is how do we relate to the process, the parallel development of the merger of SASB and IRCs to create a value reporting foundation. This is a question from George Dallas. We had seven okays. I think that, I mean, both the group of 5 and us, like the whole world, understand that there has to be a process of consolidation on these standards. And some of these organizations have broader scope, while we'll start, I mean, our proposal is that we will start with a narrow focus. So you can think of a synergic organization architecture where the IFRS will start with a narrow focus, and then this organization will keep on doing the work on a broader focus, but in the spirit of, at the end, of having a common architecture.
Lucrezia, can I take one of the questions here? There's one question about that. How long will it take to get this all set up? It's a fundamental question. And I mean, the history of standardization is a very slowly moving process. But I must say that this post-COVID world may put a challenge to us. We are seeing how normally new medicines or vaccines are being developed, how they are got to markets. We just didn't have the time, and our regulatory frameworks were able to adjust. Political frameworks were able to give a reply. So if there's a sense of urgency in the climate, I think we should be able to move always forward and faster. And in climate, it's in a way clearer because the issues are well known. And if there's major political agreement on the objectives like Paris Agreement is, it will be helpful. But we must be able to move faster than we have used to. But of course, it needs proper preparation and clear responsibilities who are doing what.
There was one part of George Dallas' questions, whether, I mean, the SASB and IRC merger is considered to be a competing initiative. I think you should ask the question to them as well, but my answer is no, actually. We are actually, as I said before, the spirit here is to have, to move, to simplify and to consolidate.
So we then move to the academic session after all these great questions.
Okay, so now you are the chair, Dirk,
yeah.
no?
Yeah.
Okay.
Okay.
Well, first of all, thank you, Erki, and I think thank you for clarifying all these points. Thank you.
Yeah. So thanks for so we have the great introduction now. Now we go to the academic panel, the keynote even. And we are really happy. I already said Christian Leuz, one of the members of European Corporate Governance Institute from the Chicago Booth School of Business. And Christian is really a very rare animal, if we put it in Darwinist terms, because you have many professors of economics, many of finance, and many of accounting, quite a few of economics and finance, and quite a few of finance and accounting. And I'm in a business school where finance and accounting is on one floor. They try to merge the departments, but they don't like it yet. But I think there are not that many professors of economics, finance, and accounting. And Christian is one of them. And economists always get excited about the effects of disclosure. And accounting is helping out there. So we are really fortunate to have you here, Christian, because from your combined expertise from looking at capital markets and looking what accounting is doing, you are putting the two things together, which really gives a unique perspective. And you've written quite a bit on it, and you have been advising in the US some of the standard boards, so you're really an insider into the topic. And next to that will be my colleague of the Impact Economy Foundation, Adrian, the Groot Ruiz. He started off also in academia as associate professor of finance, but then he found quickly out if we really want to move forward on sustainability, we need information on the issues. He started off, he's a co-founder of True Pricing, later on the Impact Institute, and now he's working at the Impact Economy Foundation to bring these concepts into practice. What the organization is, first half hour is by Christian, then 15 minutes by Adrian, and then we have 15 minutes left for Q&A, and then we go to a small break. So Christian, the floor is all yours.
Thank you very much, Dirk, and thank you, Lucrezia, for having me. It's an honor to be in this session and to be asked to give the academic briefing today. Let me first make sure that everybody can hear me and that you can see my screen. Is that, we're good? Okay, perfect. Thank you, Marco. So I should probably start with a disclaimer here and say that the remarks I'm going to make are largely informed by my own research background, which is mostly in international accounting, disclosure, and financial reporting. Dirk was already giving me the prize for the longest title in the profession, but I'm sort of more in accounting and finance. And in particular, I've only recently entered sort of the area of sustainability. And this happened when Hans, Lucy, and I were asked to write an independent research report for the SASB on lessons from academic research for sustainability reporting regime and standards. And that became the paper that you see, sort of the little image on the right on the slide here, in which we draw not only on sort of empirical results with regard to sustainability reporting, but also on the broader reporting and international accounting literature, because we see a lot of parallels. And I think these parallels and their relevance have become quite apparent when the IFRS Foundation entered the stage. So my goal is to present some lessons from the literature and primarily set the stage for the discussion today. So with that, let's jump in. We're all aware of the big picture. The climate change and environmental issues pose massive challenges to humanity and have set and led to a major public debate on climate, sustainability, environmental issues. And investors and business leaders, some would say finally, are taking note. And I put here, which are probably admittedly US-centric examples. There are many others, and Erke was pointing out that Europe had started to take note much earlier. It's also true that regulators and central bankers have become quite concerned about climate risks and have expressed it. What is relevant for today is that sustainability reporting is an important part of the debate, and that's sort of what brings us to the event today. So there is a major effort underway to establish reporting regimes, and there have been for a while. So let me talk a little bit about this push. The push for sustainability reporting is in part coming from investor and stakeholder demand. That's again something that Erke also emphasized on the investor side, but there's also a lot of demands by the stakeholders. And many see a reporting regime as a first and a critical step towards achieving the climate and the environmental goals. So where you see this as an example, for instance, when the Financial Stability Board was tasked by the G20 and the governors to think about the climate risk, one of the first things they did was to establish a task force on financial disclosures. Again, showing that disclosures and information and reporting regimes are a critical element. There are many standard setters out there that propose solutions. I put a couple up here on the slide, and the IFRS Foundation, this is why we're having the event today, is considering whether it can play a role. So what are some of the key debates and questions in these debates? One is, should reporting be mandatory? And by reporting, I mean sustainability reporting. Should there be a global set of standards, and if so, which one? And what is the goal of sustainability reporting? So let me start with the last one, but I will sort of throughout the talk comment on various aspects of this. And let me start here with the goals and kind of give you two extremes along a spectrum. And I admit that they're a little bit, that they're potentially caricatures and things are more complex, but you could characterize one goal as giving investors what they want. And goal two could be viewed as driving change with sustainability reporting. Now, these goals have very different implications, but in the debate, it's often not quite clear which goal we're talking about. And one of the points that I'm making throughout is that it's important that we're clear about which goal we have in mind. And here, I'm going to use the IFRS Foundation as an example, but not to pick on them or criticize them, but just to show how easy it is to potentially send mixed signals in terms of the goals. So in the motivation for the consultation, there are references to what I would see go as a goal two. The ECGI post, for instance, that with which the consultation paper was posted, also makes references to what I would perceive to be goal two. But the consultation paper seems to have primarily goal one in mind, which is a focus on investors and single materiality at first. So let me illustrate why distinguishing between these goals is important. And if we think about which goal it is, we should go back and ask, why has sustainability reporting become a big and an important topic? It is clearly the existential challenges due to climate change, loss of biodiversity, and many other environmental issues. It is fundamentally about the externalities of corporate activities that are a genuine problem. And so focusing on investor and information needs to some extent largely ignores these externalities, which is in particular true if we think that investors want to maximize shareholder value. But that's not a given. What if investors have preferences beyond shareholder value? Then externalities matter to them. Now, they want sustainability information because they care about the environment. That's part of their preferences, so that they can monitor and potentially monitor the firm, that is, and potentially change firm behavior. These preferences move us in the direction of goal two. And now the focus is no longer just on financially material ESG factors. It is also about the impacts on the climate and on the environment. So let's talk about these goals. I think this kind of illustrates why the goals are so important and why we need to be clear about which goals we have in mind. And so let me start with sort of the goal one and start with a narrow version of goal one, where we focus primarily on financial materiality. Now, for this goal, I would argue that the current reporting regime is probably not too far off. And what I mean by that is conceptually. In most regimes, financially material information has to be disclosed. And it doesn't matter whether this is about ESG activities or the firm's core business activities, right? Financial materiality is a cornerstone of the IFRS. It's the cornerstone of US GAAP. And so these type of informations, regardless of what activities they stem from, have to be disclosed. So then the important question for practice is actually, do firms provide all financially material information, even for ESG factors? If the answer is yes, then I think the status quo, which is one of the options that the IFRS Foundation is saying is also on the table, is pretty close to achieving goal 1. Now, there's some reasons to be skeptical. And here, one has to see that climate risks and many of the sustainability issues are relatively difficult to measure. For many firms, they're also new in terms of to what extent they really sort of are on top of measuring these risks and aware of these risks. And in particular, a lot of them are longer term in nature, which may also make them more difficult to measure and be aware of them. On top of that, it's hard to know for investors what is actually material for a given firm. So they might not know when a firm is withholding information that might be material. So normally, when investors fear that a firm withholds information, they react negatively, right? That's the notion of, no news is bad news. And those forces often then bring the information out. And what I'm pointing out here is that those forces might not work so well in the context of sustainability. So non-compliance and lack of information are a real concern. So if we now embrace the narrow version of goal 1, and by that I mean if we argue that we need sustainability reporting, a mandate or standards to achieve goal 1, then I think we're essentially implying or saying that firms are currently not providing ESG information that is financially material. Now, know what this does. It shifts the focus on what needs to be fixed. Now, the key issue is enforcement and making sure all material information is actually be disclosed. In this case, it's not clear to me that we need a new sustainability reporting framework or a separate standard setter. The focus is squarely on the existing financial reporting regime. Now, note that that's not a bad thing necessarily, because that may mean that some things we can already achieve under the current and existing financial reporting regime. Note also that I'm not saying that that means that we don't need any new or additional standards. They could actually be useful, and they could be useful in particular when it comes to the enforcement and this materiality problem that I was just describing. Right, so here I could see industry-specific sustainability standards creating an expectation of what needs to be reported for a certain industry or for a certain firm, and it's a refutable expectation that then triggers, what we often call comply or explain forces, where investors have a certain expectation that if this is not material, the firm would at least explain why that is the case. Now, there is an alternative interpretation of why we need sustainability reporting standards, and that is compliance is not the issue, but we need standards because the information is simply not well organized or harmonized. Now the relevant problem is to harmonize sustainability reporting, right? And when we say harmonize sustainability reporting, presumably what we have in mind is sustainability reporting practices. And that is very important to make a distinction between standards and the practices. And I think here is where we can learn a lot from IFRS adoption, which is sort of an area that I have researched extensively. And so here I would say one of the lessons is that standards are useful, but they're only one input. They're clearly not the only driver, and probably not even the primary driver. Dirk has already alluded to this in his opening remarks. Enforcement is a critical issue here. And this is something that matters in this context because the ISB and the IFRS Foundation, do not have enforcement powers, which is why thinking about partnerships like with IOSCO and the regulators would likely be very important. But I think also for sustainability reporting, the enforcement issue is likely to be a lot more pernicious and difficult because we're dealing with externalities, we're dealing with a global problem. Now, the third point, and this is probably the most important driver of reporting practices within the constraints that the standards and enforcement set is reporting incentives. And so what I mean by that is that think about what standards normally do. Standards can't foresee every possible application, So standards always come with discretion. They come with room where the issuer, the preparer, decides how to apply the discretion. How that discretion gets applied is very much shaped by incentives. It's very much shaped by forces like the market forces, the legal institutions, the local traditions. And here, I think there is a significant challenge for sustainability reporting where the range of incentives is likely to be even larger. And so I want to give you two examples here. So think about, a single set of sustainability reporting standards. And let's say we have that. And now think about that set of standards gets applied in the US. For a US preparer, the litigation system in the US will be front and center on the mind of the preparer in the US. Right? That same set of standards now applied by a preparer in Europe, where stakeholders have traditionally played a larger role. So think Germany, where, for instance, the labor and the employees sit on the board. They will have their stakeholders and their demands and the forces they create on their minds. And so even with a single set of standards, we could get very different reporting. But what's the conclusion from that is, one, I think if we aim to harmonize practices, we need to be realistic what standards alone can achieve. And if I had to sort of say, or what one key thing that I've learned from IFRS adoption on the financial reporting side is focusing on building the infrastructure and less on the standards is, in my mind, one of the important lessons. So let's move on to goal 2. So with goal 2, the idea is that we're driving change through sustainability reporting. Climate change, for many, climate change, by the loss of biodiversity are pressing issues and they face points of no return. Right? So the focus here now is on the externalities, addressing the tragedy of the commons, as the economists call it, and aiding the other efforts that are underway in this domain. From that perspective, there are two important questions for the goal 1 supporters. So if we interpret sustainability reporting more narrowly. And those questions are, what evidence do we have that investors push companies to internalize their external effects, right? So I think it's really important, what evidence, and I'm not saying there's no evidence out there. I think more recently there's encouraging developments where investors are driving change. But we should ask, what incentives do investors have? What evidence do we have? And in particular, what concerns me, there is quite a bit of evidence out there that investors might have drive short-termism of firms. And so I think revisiting that evidence and thinking about this is important because it leads to the second question, which is focusing on investors and single materially potentially taking the pressure off? And this is something that the IFRS Foundation wouldn't want, and the standard setters in this space would not want. And I think that is a significant concern and something that should be taken very seriously and debated. There's also a question for the goal 2 supporters that is, in my mind, very critical and important. And here the question is, why is disclosure the right approach to address externalities, right? Or to address externalities together with the other approaches that are out there? Well, one obvious answer is that we need information and that a reporting regime complements the other efforts that are out there, carbon regimes and so on. But I fear that there's another reason. One reason why transparency solutions are often pushed is because they're easier to agree on. It's hard to oppose politically transparency because transparency is viewed inherently as a good thing. And on top of that, I think there's the perception that transparency regimes are less intrusive than regulating behavior directly. So to have comply or, to tell command or control type of systems where we tell companies what to do or what not to do. Now, what I want to emphasize here, and we emphasize in our paper, is that transparency regimes are not innocuous and they're not necessarily better than sort of more traditional command and control type regulation where we tell companies what to do and what not to do. My read of the literature is that we need to be very judicious when and how we use them. Now, what are some of the core issues when driving change with transparency, right? So there's two important concerns. One is who gets to decide what effects are intended, right? So if the idea is we're driving change, but where change is societal issues, things like, you know, climate change, the environment, that change corporate actions. Normally, when we do impose traditional regulation, there is a democratic process and some democratic legitimization behind this regulation. The same would apply here if we're driving change via transparency. The second issue and concern is that reporting uses the price mechanism to induce change, and change here is what economists call real effects. And so what I have on the slide here is that the firm provides disclosure, the disclosure is received by the stakeholder, and now the stakeholder reacts to the information and imposes some kind of penalty on the firm, or, you know, gives a benefit, and that is what I mean by the price. That feedback effect is then in turn what makes the firm change, and that change is what we call a real effect because it changes real behavior on the part of the firm. Now, the issue with this process is that it's potentially quite imprecise. It's very difficult to foresee that the stakeholders, how the stakeholders are going to respond and what price they're going to impose on firms. So the question is, do consumers impose the right penalty or give the right carrot to the firm? And conceptually, we know what that needs to be. You know, this is in line with the idea of carbon pricing, is that you want to impose the Pigouvian price on the firm to internalize the externalities. But it's not obvious to me that the consumers or the stakeholders, you know, will necessarily impose the right price. So in that sense, the concern about unintended real effects is real. This is a serious concern that I think for the Goal 2 supporters, we would have to think long and very hard about. And here, I think it will be true that the broader the regime, the broader the real effects, both the intended ones, the ones that we want and why we're getting into this, but also the unintended ones. And so here I want to give you an example from healthcare. New York and Pennsylvania introduced mandatory report cards for bypass surgery. So these were hospitals and providers that had to give information on the mortality rates of bypass surgery. And so researchers looked at that. There's a great paper by Drainoff et al. That basically shows positive effects, but more importantly, it gave doctors and hospitals incentives to decline to treat the more difficult, meaning the severely ill patients. And they find that on net, the health outcomes were worse, particularly for the sicker patients. Now that obviously should give us a lot of pause, right? Because that was not the intention of this regime, which was to help patients choose the right provider and presumably give some incentives to hospitals for good outcomes. Now, what do we learn from this example? We learn that driving change with transparency can be very pernicious. The real effects are difficult to foresee, and they're not all going to be intended. But we also learn a second piece that is very important to me, which is that measurement is key and very important. So think about the example again. What was the problem in this example? The problem in the example with the reporting regime wasn't transparency per se. The problem was the measurement, because we were just disclosing the mortality rates. And so then the consumer, the patient, could not necessarily disentangle, was a bad outcome on the report card the outcome of a severely ill patient on the way in, or was it that the doctor was not treating, or the hospital was not treating the patient well? Right? That in turn then created the concerns for the doctors and the providers to potentially select the patients. So the message here for sustainability standards is that we need to think very hard about measurement, and that is why we need a technical and scientific basis for the standards if the goal is to drive change. Let me give you a final example and then conclude. In here, I want to illustrate something about materiality. So think about plastic drinking straws, right? The ones that we often get with, takeout beverages. The straw itself is financially immaterial to the beverage retailer. It's a small part of the product price. So from a financial materiality point of view, we would say, well, it's not material. But if the straws, which have become a significant concern because of plastic pollution in the oceans, because of plastic straws getting stuck in the throats of animals, lead to consumer boycotts. These consumer boycotts can be financially material. Now, again, there's two things this example illustrates. One is that, again, such effects and when stakeholders will respond and impose financially material penalties on the firm are very difficult to foresee. They're wide-ranging, especially in this area. But what's also important here, the second, is that this can already arise under single materiality, because as I said here, is the consumer boycott made it eventually financially material. And so as Lucrezia was already alluding to in her remarks, the lines between single materiality and double materiality are blurred, and perhaps they're perhaps closer together than we often think. So with that, let me conclude. Before I wrap up and give you the key takeaways, let me start with a caveat and say that in our ECGI paper and in the academic literature, people point to many challenges. And this is kind of what you'd expect from academic research, right? That's our role, is to point out challenges, issues. But we should also realize, and I certainly do, that the perfect is the enemy of the good, right? To some extent, we can move forward without a positive solution. But I think if we do that, we should be clear about the goals that we have in mind as they shape the way forward. So is it that the issue is non-compliance with IFRS when it comes to ESG? Well, then I think we should focus a lot on how we can do things within the given reporting framework. Is the issue that we need the harmonization of the reporting practices? Or do we intend to drive change? As I've explained, they have very different outcomes. We can learn quite a bit from IFRS adoption, and I would encourage us to sort of look at this if the goal in particular is harmonizing reporting practices and getting a global set of standards. Here, I would say the message is don't focus just on the standards. Think about building an infrastructure, leverage market incentives, especially on the compliance and the harmonization of incentive side. So here I feel like exchanges and finance can actually play an important role. Then the next is, it's not clear to me that the focus on investors and single materiality addresses the externalities and the pressing issues. And I think here the key question is that, or concern is that it could take the pressure off unless we step it up elsewhere, right? So that, in my mind, is the biggest issue to think about in the context of Goal 1. Now, the stakeholder focus in double materiality will help with the pressure and the Goal 2. But I think here the key issue is that we need to think very much about the potentially unintended consequences, and a broader focus in double materiality will bring more unintended consequences and real effects. So in my mind, there is a clear trade-off that we need to see, and driving change with transparency is not innocuous. We can certainly say that from the literature. And so maybe as a silver lining, one thing to think about is one combination to consider is combining a topic focus of a reporting mandate and double materiality. So in a sense, limit the focus on the most pressing issues with irreversibility concerns, climate, biodiversity. But then to limit the scope for unintended real effects and consequences, limit them to those areas that matter the most, that are the most pressing. That's sort of the idea. In doing so, it allows us to learn and to build an infrastructure, and once we have it, sort of expand it. With this, let me stop and turn it over to Adrian. Thank you very much.
Thank you very much, Christian. It really gives a great overview of the whole field. And you lift up to your long title, because I think it really combines really nicely accounting, but also expected economic effects. Let me take one question or two questions basically from the Q&A, because you nicely distinguish between the two goals. Investor protection is about value creation by the firm, and the second goal about what happens to society, what we call as economists externalities. And I've two questions from Samantha Ross and from Willem Schamade. They ask, are the externalities and also intangibles, which we already know for a longer time, 70 to 80% of firm value is intangibles. Are these externalities not also relevant for value creation? So in the end, there is not a big distinction. So are these externalities not relevant for value creation by the firm?
So first of all, hi, Sam. I can't see you, but it's great that you're here. And these were great questions. So I would say that what you're pointing out is very related to one of the examples I gave with the drinking straws, although in the drinking straws, it's not about value creation, but that example also was to highlight that double and single materiality are perhaps closer together than we think, and that many issues, especially once the stakeholders start reacting, are going to be relevant to the firm and financially material, and therefore also matter for the value creation of the firm. And so in a way, if there has been a massive shift in terms of what stakeholders and investors care about, which I think we're starting to see, then that also means that shifts in terms of what is going to be relevant for the firm and the creation of value. Now, there is a sort of a second aspect of it which is what really, how we define value creation. If we have in mind with value creation, shareholder value, then I would say you can get the situation where many of these externalities are ignored. If you define value creation more broadly and acknowledge sort of in a Hart and Zingales, Oliver Hart and Luigi Zingales have an interesting paper in saying, well, ultimately, it's actually not about shareholder value. It's actually about shareholder welfare. And to the extent that shareholders care about wealth, we care about shareholder welfare and creating value for shareholder welfare, then I think a lot of those issues will be squarely relevant to the firm. And in that sense, I would agree with you that you would then say that this information is relevant even under a value creation perspective.
Thank you very much. That's really, I think what it highlights, your answer, Christian, is what I think Lucrezia at the start called, or Erkki, dynamic materiality, that in the end, it is a flexible concept rather than an analytically completely different, what you're saying. Now we move quickly on because I'm a timekeeper and I promised to do the full Q&A after both.
Can I ask something quickly? Just a clarifying question to you guys who have been thinking about this, these things from an academic perspective. Why do you think that the single, when you focus on the value of the firms and you don't take in consideration the externality problem? After all, I mean, if there were no externality, there wouldn't be any need for reporting, for financial reporting either. I mean, the fact that there is financial reporting, that implies that we believe there are externalities, otherwise the market would do it, right? So, I mean, just question.
No, this is a good question, but I think we're talking here then potentially about different externalities, right? So for financial reporting and why we have, I mean, you're certainly right. If there were no externalities, why would we even mandate financial reporting? And it is mandated everywhere. But the externalities here are the notion that information is a public good, and as a result of that might get underprovided. And so in that sense, the externalities are with respect to financial information that are valued more by investors than they may be valued by a single firm. Or there is concerns about proprietary costs, which for any given firm might make the firm not disclose it, but if you impose it on all, you mitigate some of the proprietary cost concerns that otherwise would matter. So it all evolves around the information regime. Whereas I think the externalities that we're talking about when it comes to sustainability reporting are externalities of the firm's actions and business activities on the environment and on the planet, and that those externalities are not necessarily accounted for under the financial reporting regime, if what we're focusing on is sort of what we're focused on is financially material, and that potentially means shareholder value maximization, which is sort of narrowly and would not include these externalities of the firm's activities. Think tax avoidance sort of would be a classic example where it's in the interest of the firm to reduce its taxes, but that may not be in the interest of society. And the question is, to what extent would investors have an incentive to pressure the firm to not engage in tax avoidance?
Yeah, it's about incentive, not externalities, because as we know from financial regulation, okay, so that there are spillovers, and then there is a difference between regulating a single company, a single bank, a single financial institution, from regulating the system, right? So, the distinction is not that clear to me. But anyway,
no, I agree. There are similarities for sure.
Yeah.
Now we move quickly on to thanks both of you. To Adrian for your part. Adrian, the floor is yours.
Thank you. Can you hear and see me, or the screen at least?
Yes.
Dirk and Lucrezia, I would like to thank you for the invitation. So, in terms of the reflection on Christian, I don't feel particularly compelled to argue with his conclusion, as he is the expert on the economics of financial reporting. Let's see. Sure. Yeah. Can you see the screen?
Yeah.
Excellent. So as said, I don't feel a big need to take aim with the arguments of Christian. He's the expert, and also I essentially agree with his arguments. I would like to highlight two things. First, I do believe that the potential effects of mandatory sustainability reporting are potentially larger in sustainability reporting than for financial reporting. The reason being that the divergence and the heterogeneity of methods for financial reporting when IFRS started was arguably much smaller than the heterogeneity in methods to measure sustainability now. As in sustainability, we don't have the many, many years of accounting practice that existed back then. So I see there a very large potential effect. Second, I think Christian is right that for goal 2, disclosure is not sufficient to internalize externalities. So I would propose that disclosure is a necessary condition. Without measuring the effects, one cannot internalize them, but it's not a sufficient condition. Then I was mainly asked to make the link to more innovative reporting practices. And hence I would like to build and zoom in on one particular aspect of Christian's contribution, the role of externalities. So what is their relevance? How could they be integrated in reporting? And what are current reporting practices around externalities? So the starting point is the maxim most eloquently articulated by Milton Friedman in his 1917 article that the social responsibility of the firm is to increase its profits. So it first establishes the common ground that the economy and businesses are here to serve society, and that the focus on shareholder value is justified on the basis that it is in the best interest of society. And this paradigm, so you will, influence leaders in business and governments for the past half century, as these quotes by Salesforce CEO Mark Benioff or Professor Stiglitz illustrate. And so as Mark Benioff says, that he will never forget reading Friedman's essay and that it influenced a generation of CEOs. So it shows the real impact that ideas can have. So we can debate the exact influence of Friedman's ideas across the globe. In any case, we can see that the current IFRS standards, which is a global institution, fully adhere to that vision. So they stipulate the information rational decision makers need to know in the Friedman paradigm. And the beauty in a way is that it doesn't matter whether the decision maker using the information is a CEO, it's a selfish investor, it's a pro-social investor or government policymaker, they all would like to see the same thing happening, profit maximization. And that justifies very strong public policy around reliable corporate reporting on profit and shareholder value. And before going to the externalities, I think it is important to stress and appreciate the power of profit-based market practices, or more colloquially, capitalism. And so profit-based markets have brought massive material welfare to society. Since the start of industrialization, the global GDP per capita has increased tenfold. And the share of people living in extreme poverty from 1981 to 2015 declined from 42% to 10%. I mean, that's a massive decline in extreme poverty. And that is arguably mainly due to economic growth as the result of adoption of profit-based markets in developing countries. So I think that is important to keep in mind. At the same time, there is one problem. So Friedman's analysis relied on the assumption that externalities are absent, small, or solved by the market. And 15 years after his paper, empirical research have shown that this crucial assumption is false. So as a result, due to significant externalities, profit maximization leads to large welfare losses. And climate change is the best known external cost. 66 banks, central banks across the world, has estimated that it could lead to a 25% decline in global GDP. But there is more. An IPBES-UNEP study showed that 1 million species are threatened with extinction. On the social side, more than ever, are there people enslaved currently, 1 in each 200, so 50 million people across the world. And also unhealthy food products cost annually 11 million lives and 250 million healthy life years. And also zoonosis, COVID, that's a zoonosis, a well-known externality among scientists, will cause this and next year around 1.3 million deaths or more, and a cumulative output losses of $9 trillion in the coming 2 years. And that will be the deepest recession in 80 years. So that means that due to externalities, the social responsibility of the firm is to optimize stakeholder welfare. And the New York Times published an anniversary publication, and in that also very prominent CEOs expressed the need for a new kind of capitalism around stakeholder value. The same Mark Benioff, but also Larry Fink. After contextualizing it, he also argues that businesses have to create value for their stakeholders. And there are more, for example, the father of British venture capitalists, Sir Ronald Cohen, has consistently been making the case for an impact-based economy. So there's one problem. What is stakeholder value? Because Friedman made another observation that many overlook, because he said that if businessmen do have a social responsibility other than making maximum profits for stockholders, how are they to know what it is? And the problem is that stakeholder value currently is not measured nor reported, and it is a multidimensional social construct. And you see that current metrics are insufficient, and so for a couple of reasons. First, they focus on policies, intentions, efforts, or outputs, the percentage of sustainable investments, but they do not actually measure what is material to stakeholders, so the impact on their welfare. In addition, many indicators are not comparable, resulting in the arbitrary weighting of, say, tons of CO2, people who didn't receive sufficient income, and adherence to policies. And as a result, the resulting metrics have quite a lot of bias and inconsistency. An MIT study showed that ESG ratings of the top credit rating agencies have correlations around 40 to 60%, whereas their actual credit ratings of the same organizations correlate around 99%. And so that is a massive problem, because then how well a firm performs depends on the credit rating agency you would go to. So what is, so it is quite crucial to address the Friedman challenge to specify what is the information required for rational decision-making. And based on insights of formal decision theory, one can formulate a couple of criteria. First, disclosed information should cover all material impacts. So as an investor, I cannot make a rational investment decision if I know the climate impact, but I do not know the biodiversity or health impact, because that could lead to different ranking of the alternatives. Second, the information should be quantified. I cannot make a rational decision based on qualitative information because I cannot weigh two indicators that say it's quite good with one indicator that says it's quite bad. Third, it should be valued, or as economists say, expressed in a numeraire, because trade-offs have to be made. If you have like 50 or 60 impacts, you have to make trade-offs to optimize the decision-making. So to make a choice and rank alternatives, the various impacts have to be valued. Fourth, impact should be attributed amongst the companies. So if in a value chain, say in the making of a car, you have carbon emissions, those carbon emissions should be attributed to the various organizations involved in making that car. Because otherwise I cannot consistently compare if I invest in the company making the car engine versus the company selling the car, for example. And finally, there are 2 points that in the disclosure of the information, it should be differentiated per impact, capital, and stakeholder, but also per welfare dimension. For example, in terms of well-being, but also in terms of respects of human rights. And these 2 final points are required as different decision makers, different investors may well have different preferences. So they need to be able to make their own weighing among stakeholders or capitals or welfare dimensions. So to organize this information, we suggest having impact-weighted accounts organized around organizational goals, because that's a lot of information potentially, so you need to organize it well. And if you think about it, financial accounts are based on financial goals. And so you have a goal to have profit, and you have a profit and loss account. A goal is to have liquidity, so you have a cash flow account, and a goal is to have solvability, and you have your balance sheet. So similarly, we suggest 4 concrete impact-weighted accounts around 4 goals. So one goal is to create long-term financial value for investors. So you need an investor value creation account. Another goal is that you want to create net value for each stakeholder. So you want to have a value creation account showing that net value per stakeholder group. Third, do no harm. So you want to respect the rights of stakeholders and avoid imposing external costs. So you don't want to create value for one by breaching the right of another stakeholder. And finally, you want to contribute positively to the Sustainable Development Goals. So you want to have an SDG account showing the contribution to the Sustainable Development Goals. So if we look at this perspective, it is very encouraging to see that businesses are actually starting to report on their quantified and valued impact. There a study by the Harvard Business School in 2019 that they tallied that 56 public companies disclosed in a monetized way on their impact. And in the last 2 years, quite some new initiatives have started that experiment that, like the Value Balancing Alliance, that have quite a few companies behind that. You also have a Banking for Impact working group with various banks, and there are even SMEs involved in doing so, which is quite interesting to see. One thing that you can observe is that there's quite a lot of diversity in reporting. Now, to have a couple of examples to make it tangible, this is an energy company, Alliander, and they publish for 4 years an integrated profit and loss account, and they report their monetized impacts according to the 6 capitals of the IRC. For example, it shows around 2 billion in net value creation in terms of manufactured capital, and that is mainly the benefits of the energy transportation to consumers and businesses. And in natural capital, for example, you see a climate change cost of around 280 million, which is around the same order of magnitude as their profits. And so there you also see that it can be quite risky. So from both single or double materiality, that is relevant to know. An example in manufacturing industry is BASF, and they have been publishing for quite some years their value to society, in which they quantify and value their impact, and they classify it according to economic impact, social impact, and environmental impact, and also according to is it in their upstream value chain, own operations, or at their clients. One example that's quite advanced in the financial sector is ABN AMRO Bank, and they publish their impact statements. So they compile a detailed integrated profit and loss with 52 impacts classified by 4 stakeholder groups and 6 capitals. They chose, given the innovativeness and uncertainties, to report in bandwidths. And on the right-hand side, you see an overview of the value creation, summary overview by stakeholder and capital. So the interesting part is that if you account and quantify in a consistent way, you can also create some clarity. For example, you can map the figure by the statement of intent of working together that distinguished a couple of topics. Is the reporting already reflected in the financial accounts, or is it also material for enterprise value creation, and is it material from a double perspective? And here you can see quite clear where that falls. And so current reporting mainly reports financial and manufactured capital. Then you have reporting on matters that reflect the impacts on economy, environment, and people. That is basically the whole picture. And then that subset that is relevant for enterprise value creation are the non-financial impacts and the financial impacts just for investors. So they also report their external costs separately, because they do not want to net external costs like climate change against, say, for example, profit, as it is something they steer on separately. And they also report their impact classified by SDG. And for example, on SDG 8, decent work, they report 1 to 5 billion positive impact, whereas on SDG 13, climate action, 100 to 500 million negative impact. I would like to conclude with a couple of questions or considerations for the IFRS consultation. At EVE, we're still compiling our formal response, so these are just a few questions I personally would suggest the IFRS trustees and community think about. So first, could taking a holistic perspective help to minimize changes in principles? And so climate is an existential risk, and it is very wise to take a phased approach and start with climate. But it is also important to take in mind that there are many more, like biodiversity or pandemics or privacy. And if you don't take that in mind in formulating your framework and principles, it could be that every time you incorporate more material impacts that you have to revise your fundamental principles, definitions, etc. Second, the question is, how can the IFRS create a dynamic and inclusive standardization process? Measuring sustainability is a young discipline that requires a multidisciplinary and multi-stakeholder approach. That is an important challenge. And finally, could the Sustainability Standard Board focus not lie on impact instead of dependencies? So coarsely, your impact is the ton of CO2 you emit, and your dependency includes the fact that CO2 emissions have on your shareholder value. And there are 3 reasons for that. First, impacts are relevant for both single as double materiality, as you kind of abstract away from that discussion. Second, you could wonder, as Christian also said, if the dependency, so kind of the financial impact, if that is not more the remit of the IASB or financial analysts, because if you do it well, you will come with an adjusted valuation of your assets. And then you wouldn't want to have the SSB recommending a different valuation of assets than the IASB. And finally, the dependencies are more complex because you need to quantify the impacts and then quantify the feedback loop from that impacts to those dependencies. So you also make your life simpler by focusing on the impacts. So with that, I would like to conclude and give the floor back to Dirk.
Thank you, Adrian. Just one quick question. Your first consideration is about a holistic perspective. And well, I think you also recognize that we need a credibilist approach how to get there. How do you see that happening?
Yeah, so one way of happening is that in addition to providing advice on climate change, that's quite detailed, also be able to provide a holistic framework and give the categories. So for example, can you recommend using 6 capitals? Can we recommend reporting according to stakeholders? So having a couple of those holistic principles can really help. And then you don't need to have guidance on how to quantify the impact on each of those categories, but having a picture of the end in mind and providing high-level guidance on the relevant topics, that could be a way forward in that respect.
Thank you. We discussed externality and external effects a lot. But there is one really interesting question which I would like the person also to ask. Hali Matusha Dia, I hope I express your name correctly. If you would like to ask the question about integrated sustainability into the corporate culture, because we talk a lot about the effects, but how do we get it done in the corporates? Would you like to come in?
Sure.
Wait a minute. So I would like Hali Matusha to say a little bit more to the question. Okay, that's...
Dirk, I don't think they can, right?
Okay, yeah, and then I can give them access. But then let's get going, and both of you can take that up. So how to integrate it into corporate culture?
Adrian, this is for you.
Yeah, so I think that's a very important question. It also relates to Christian's part, that the reporting part is one, but you also need the infrastructure, and that is in a way an infrastructure in technology, but also in regulation, but also in culture. And one important part is in a way the training of the people, that you have to educate and train people in order to one, do the technical part. So how are you going to measure and report on this? But also in terms of the management part, because it does make managing more complex, because you have a multidimensional objective function. You have to focus on more things. And as we know from the bounded rationality literature, that is harder for people to do. And so it focuses on the one hand on the technical parts, but you also need the education on the management side. So I see that educational part happening, should happen at business schools, but also in postgraduate education as being quite crucial in that.
Christian, would you like to add to that?
No, I'm fine. I think we should take a few questions maybe from the audience, so otherwise we're running out of time.
Okay, then I have one extra question from Lane Pape, and maybe Lane, if you want to come in and unmute yourself.
I just did, Dirk. Yeah, can you hear me?
Yeah, I can hear you.
Yeah, you can. Okay. Well, just today I ran into an article, a paper in AOS, and that was about materiality. And they researched whether investors were willing or understanding the issue of materiality. And the outcome was they don't. And they don't take it into account when coming up with any decision to invest in a company. Now, and this is, I would say, hard numbers in the case of auditing materiality for financial reporting. And of course, we are going to adhere to materiality as well in the context of integrated reporting and sustainability reporting. So I guess this is going to be a real issue, even if in the case of hard numbers, investors don't understand, they're not willing to take that into account. How are we going to make sure this is not going to happen in the case of integrated reporting?
Thank you, Lane. I think, Christian, that's for you.
Yeah, I mean, I agree. And I think this is, I've not read this particular article yet, but I think what you're reporting is very much in line with what I was saying earlier as to why I think there are some legitimate concerns and questions around materiality and to what extent firms are providing all financially material information when it comes to sustainability issues. As I said, part of the problem is that firms themselves may not be fully measuring them. Adrian was pointing out that this is relatively new. And it requires changes in the company. And then the same thing applies to investors. Investors may also not fully understand it. And then the normal unraveling forces that we usually assume don't work. And I think even for financial reporting, we can point to examples where not all information is necessarily provided. So that is why I think an obvious first step that I think we can go under the current regime is to say, what can we do to improve the provision of financially material information under the current regime? To me, that seems like an obvious step one that we should be able to do and can do this within the current frameworks. And it is an issue, I think, under IFRS and an issue under US GAAP. So it's not something that comes with sustainability reporting.
Thank you.
I have one question. I will read them out from Amna Chalati. Christian, you earlier referred to the comply or explain regime. And then Amna is asking, might it not yield a boilerplate sustainability disclosure? So does that not give problems if we do comply or explain in sustainability disclosure?
Yeah, so here I think there's an interesting trade-off that we actually also talk a little bit about in our paper, which is I think the concern about boilerplate disclosure is a significant concern, and we know this also from risk disclosures of companies where people have sort of pointed out that many of these risk disclosures look fairly boilerplate. Now, one way to, I think, counter that concern is to be relatively specific about for particular industries. So this is one thing that I like about, for instance, about the SASB approach, is to think about industry-specific standards and issues that are material coming from the technical side, from the business processes, the production processes, and so on, and think about what are the material issues, and then create an expectation that in this industry, this is typically a material issue that the company needs to explain, why it is or why it isn't. And so the trade-off that I was alluding to at the beginning of my answer is that the more specific you make the standards and the more industry specific they come, the less you're going to get a harmonization across firms, right? The more you're going to create, again, sort of things that are specific to certain industries or certain firms. So there is a trade-off. I think if we say our overarching goal is one set of standards globally for everybody, then I think that runs the risk of creating more of these boilerplate disclosures.
Thank you. Then I have one final question because we are running into the break. This question is for Adrian. Alicia Okawa asks, okay, if you have these impact accounting statements of individual companies like ABN AMRO, which you showed, which are self-audited, is there a need for an independent external auditor to verify these reports? So I'm now looking also a little bit to panel 3, but let's have already your view on it. Is there a need for independent external auditors?
Yeah, I think that's an excellent question, and the answer is a wholehearted yes. That is crucial because it is important that investors can and other stakeholders can rely on the information, and there may even be more than in financial numbers. There may be different motivations. Interesting to note is that what ABN AMRO did, that did receive limited assurance from their auditor EY, and for example also Allender received limited assurance from Deloitte. So that is a very important point, and that also requires building that capacity at the auditing firms.
Dirk, can I just jump in with one sort of additional add-on? I think auditors are assurance is going to be very important, right? That fits with my enforcement theme earlier. But I also think we should think about what role market regimes, and in particular the role that the exchanges could play. So this is going to be, I think, an interesting question for the later IOSCO and securities regulators panel, is in the sense that if we could create regimes on the markets that would require using a certain standards, providing assurance that those standards have been followed, and then have the opportunity to sort of say, if you want to play in that segment, then you want to stay in that segment, then you have to sort of follow certain standards, because that would make it very transparent to investors and markets who's playing by what standards, and it would create a bit of a commitment. And there is a dissertation that's coming out of Chicago this year, where our student who's in the market this year, Shirley Leuz, she's showing how green bond issuances could potentially help with that commitment, because they often come with reporting requirements and insurance systems around it. And to me, this is sort of a clever way to think about how finance and market mechanisms can help us with the enforcement. And that's partly what I had in mind when I was saying, let's think creatively about the infrastructure and not just about the standards. Thank you.
Thanks a lot for this last one, because green bonds is really growing extremely fast, and the basis points difference is really minor, but what you're basically saying, it is a signaling device. By issuing green bonds, you signal what your company wants to do. And
more a commitment device, I would say.
Yeah, and a commitment, because you have to live up, because you have to report on it afterwards. Yeah. So thanks all. I think the main takeaway from this session is two-way. First of all, the impact statements by Adrian shows that it's really possible. And I think the main takeaway from Christian is we have these different goals, and let's not be too much hang up between the different types of material, because in the end, it is a flexible, you get from both sides. So in the end, it will be dynamic, how these issues, these materiality issues play out in time. And I think it is now time for a break. So let's be back 4:15.